In 1962, the US government published a document that changed how Americans thought about retirement. It was called the Individual Savings Report. And buried inside it was a number, a recommendation, a benchmark that financial advisors would repeat, almost verbatim, for the next 6 decades. Save 15% of your income. Start in your 20s. Retire comfortably at 65. The math behind it was clean. You'd put in 15%, the market would compound it, Social Security would fill the gap, and you'd end up with roughly 80% of your pre-retirement income. Enough. That rule got passed down, from advisors to parents, from parents to us. And here's what's strange. A lot of people watching this are doing exactly that, or more. Some are saving 18-20%. They have the 401k, they have the Roth, they have the automatic contributions, they read the articles, they did the thing. And the number still feels wrong. The projections feel off. The calculators feel optimistic in a way that doesn't match anything you're actually experiencing. You're not imagining that. That's not a budgeting problem. That's not a discipline problem. The advice didn't change, the math did, and nobody sent a memo. I've been tracking the structural conditions behind this for the better part of 2 years. Pulling reports from EBRI, the Employee Benefit Research Institute, cross-referencing it with historical sequence of returns data. Looking at what the original 15% assumption was actually built on, and which of those assumptions have quietly stopped being true. What I found isn't a conspiracy. It's not a scandal. It's a structural outcome. A set of conditions that changed slowly and then all at once, and that the standard advice never caught up to. If that sounds useful, stay. Hit subscribe, and if this helps, give it a like. To understand why the math stopped working, you have to understand what the math was built on in the first place. The 15% benchmark wasn't pulled from thin air. It was a calculation, and a reasonable one, based on a very specific set of assumptions, 5 of them. And all 5 have shifted. The first assumption was that you'd work 40 years straight. The original model assumed you'd enter the workforce at 22, work continuously until 65, with no career gaps, no layoffs, no pivots. 43 years of uninterrupted contribution. The Bureau of Labor Statistics now puts the median job tenure at 3.9 years. The average American worker changes jobs 12 times in their career. Career gaps for childcare, health, caregiving, economic disruptions are common. The continuous 40-year contribution model was already a fiction by the 1990s. The 15% rule never updated. The second assumption was that a pension would cover roughly 40% of the gap. In 1983, approximately 62% of private sector workers had access to a defined benefit pension plan. That's a check that arrives every month for the rest of your life, regardless of what the market does. By 2023, that number had fallen to approximately 15%. The 15% savings rule was designed to supplement a pension. Most people no longer have a pension to supplement. The third assumption was that Social Security would cover 35 to 40% of pre-retirement income. When the rule was formulated, the replacement rate was calibrated for workers retiring at 65. In 1983, Congress changed the full retirement age to 67 for anyone born after 1960. That alone reduces lifetime benefits. But for anyone making over roughly $60,000 a year, which is a lot of this audience, Social Security now replaces approximately 28 to 32% of pre-retirement income, not 40%. The fourth assumption was that retirement would last 15 to 20 years. When the rule was written, average life expectancy for a 65-year-old man was roughly 78, for a woman, 82. Today, the Society of Actuaries estimates a 65-year-old couple has a 62% chance that at least one of them lives to 90. A 25-year retirement, not 15, is now the planning baseline for anyone who doesn't want to run out of money. 15% was never designed for a 25-year retirement. The math doesn't clear. The fifth assumption was that real returns would average 7% annually. That's the number behind every compound interest chart you've ever seen. As of early 2025, the Shiller P/E ratio, a measure of market valuation with real predictive power over 10 to 20-year forward returns, was sitting above 36. Historically, entering the market at these valuations has corresponded with 10-year real returns of 2 to 4%, not 7. That's not a prediction of a crash. It's what the historical data shows about forward returns from high valuation starting points. The 15% rule was built on 7%. Nobody told you the market was already priced to deliver half of that over your relevant planning horizon. You weren't irrational to feel behind. You were following a rule built for conditions that no longer exist. 5 assumptions, all 5 have shifted. This isn't a new pattern. Rules that worked for decades have a way of quietly expiring, and the people following them have no idea until it's too late. Japan, 1989. Japanese households had been told the same thing for a generation. Buy real estate, save in postal savings accounts, and trust in the growth trajectory of the economy. These weren't irrational people. Japan in the late 1980s had the second largest economy in the world. The Nikkei 225 hit an all-time high of 38,915 in December 1989. The advice that had worked for 30 years stopped working on a specific date. Not because the people following it were wrong to follow it, because the structural conditions that made it work, demographic growth, export dominance, suppressed interest rates, had quietly reversed. The Nikkei didn't return to its 1989 high until March 2024. In 35 years, the people who followed the standard advice didn't make a mistake. They followed the rule. The rule stopped being valid. Same pattern. The Nifty 50, 1972. A group of 50 large-cap American companies, IBM, Xerox, Polaroid, Avon, were considered so stable, so dominant, that analysts called them one-decision stocks. Buy them. Never sell them. The conventional wisdom was coherent. These were the best companies in America. Institutions owned them. Pension funds owned them. Then, the 1973 to 1974 bear market arrived. The Nifty 50 fell an average of 70%. Polaroid lost 91%. Xerox fell 84%. These weren't bad companies. The underlying advice, buy quality, hold long term, wasn't wrong in principle. But the valuations had embedded an assumption about future growth that couldn't be sustained. When the math stopped clearing, the rule stopped working. The pattern isn't that the advice was malicious. It's that rules calibrated for one structural environment get followed into a different structural environment. The transition is invisible until it isn't. That's what's happening with 15% right now. The rule was built for a world with pensions, shorter retirements, lower valuations, and higher Social Security replacement rates. Most of those conditions are gone. The rule is still being handed out. Let me show you the actual math. Not to depress you, because understanding the mechanism is the only way to stop being confused by your own experience. The standard financial planning benchmark is that you need 25 times your annual expenses saved at retirement to sustain a 4% withdrawal rate. That's the 4% rule, derived from the Trinity study in 1998. At $100,000 in annual expenses, that's $2.5 million. At $80,000, it's $2 million. At $120,000, it's $3 million. These aren't luxury figures. These are comfortable but not extravagant retirements. And they don't adequately account for healthcare, which the 4% rule was never calibrated for. Now let's look at what 15% actually produces. I ran the numbers on a household earning $120,000 per year, starting to save 15% at age 35. That's $18,000 a year. Using the historical 7% real return assumption, they'd accumulate roughly $1.9 million by 65. Enough by a narrow margin. Now, run the same math at 4% real return. More consistent with what elevated valuations suggest for 10 to 20-year forward returns from current starting conditions. That same household accumulates roughly $1.2 million. That's a $700,000 gap. That's the math nobody is showing you on the savings rate calculator. The 15% rule doesn't just cut it close at lower returns, it structurally fails. There's a second mechanism that's even less discussed. It's called sequence of returns risk, and it's the reason that average returns don't actually tell you what your retirement looks like. Two people can have the exact same average annual return over 30 years, but if one of them gets the bad years early in retirement and the other gets them late, the first person runs out of money and the second person doesn't. Same average, completely different outcome. The sequence of returns in the early years of retirement, when you're starting to withdraw, is more determinative than the total return over the full period. This is mathematically demonstrable and widely documented in actuarial research. And it's almost never part of the save 15% conversation. Then there's inflation. Standard retirement calculators use an assumed inflation rate of 2 to 3%. That's the Federal Reserve's long-run target. Healthcare inflation has historically run at roughly twice general CPI. The American Actuarial Society estimates healthcare costs typically represent 14 to 18% of spending in retirement and grow faster than everything else in the portfolio. If you're running retirement projections with 2.5% inflation and your actual spending is partially healthcare indexed, your projections are optimistic by a structural margin. The 15% rule doesn't fail because of one thing. It fails because 5 assumptions are running in parallel, all slightly wrong, and compounding errors over 30 years produce enormous gaps. Every time a standard rule stopped working, there's a pattern in who noticed first and who paid the cost of noticing last. When the shift from defined benefit to defined contribution plans began in earnest in the 1980s, accelerated by changes to ERISA and the 401k rules in 1981, corporate finance departments understood exactly what they were offloading: the longevity risk, the investment risk, the inflation risk. That risk transfer was largely invisible to the employees receiving it. The 401k was framed as an opportunity, a way to invest pre-tax dollars. The framing was accurate. The omission was that you were also receiving all the risk your employer had previously held. By the time this was broadly understood, the pension era was over. See, people who retired in 2000, at the peak of the dot-com bubble, experienced a 49% drawdown in the S&P 500 in their first 3 years of retirement. Precisely the window where sequence of returns risk is most damaging. Many of these people had followed conventional advice. They'd saved adequately. The timing, which they couldn't control, was catastrophic to their outcomes. The people who came through that period intact were those with pensions, a guaranteed income floor that didn't depend on market performance. Their standard of living was insulated from the sequence. The people following the accumulation model were not. There's also an institutional divergence that rarely gets discussed at the retail level. See, endowments and pension funds, the institutions managing money for the long run, have been moving away from the traditional 60-40 stock-bond model since roughly 2000. The Yale endowment model, developed by David Swensen, shifted aggressively into alternatives: private equity, real assets, absolute return strategies. The standard retail advice, Save 15%, invest in low-cost index funds, maintain a 60-40 allocation is an approximation of a model that the most sophisticated long-term money managers have largely moved away from. That divergence doesn't mean index funds are wrong. It means the institutional world identified structural limitations in the conventional model and adapted. The retail advice never fully updated. The people who followed standard advice weren't wrong to follow it. They were operating with the information they had. The structural limitations were real. The information asymmetry was also real. There are a few things buried in the data that are structurally significant and almost never part of the mainstream retirement conversation. The first is that the real savings rate is lower than you think. A 15% savings rate sounds meaningful, but savings rate is calculated on gross income. After payroll taxes, and approximately 7.65% for most workers, your gross income is already reduced before you save anything. The effective savings rate on take-home pay is lower than 15% of gross. Fidelity's Q3 2024 data showed the average 401k contribution rate was 9.4% of salary. The average total savings rate, including employer match, was around 14.2%. A significant portion of the population isn't actually saving 15% at all. They're saving 10 to 11 and calling it 15 because the employer match fills the gap on paper. Employer matches are real money, but they frequently come with vesting schedules, meaning if you change jobs before fully vesting, which given a 3.9-year median tenure happens regularly, you lose a portion of what you counted. The second hidden mechanic is the aggregation problem. Retirement savings data is routinely reported in averages. The average 401k balance for someone in their 50s is frequently cited in the $200,000 to $250,000 range. The median is approximately half of that. Averages are distorted by the top of the distribution. The people with $2 million in their 401k pull the average up significantly. So masking the reality that most people are materially behind where the 15% rule would suggest they should be. When you feel behind, and then you see average figures that seem higher than your balance, the comparison is confusing. You're not being compared against a realistic midpoint. You're being compared against a mean that's been pulled upward by a small number of high balance accounts. The third is tax treatment, and this one matters more at higher balances. The traditional 401k and IRA are tax deferred, not tax free. The tax is owed at withdrawal. The bet is that your tax rate in retirement will be lower than your tax rate during accumulation. That bet made more sense in a world where retirees had low income. But required minimum distributions, which start at age 73 under current Secure 2.0 rules, force withdrawals whether you need the money or not. Those withdrawals are taxable income. If you've saved aggressively, the RMDs can push you into a higher tax bracket than anticipated, can cause Social Security to become partially taxable, and can affect Medicare premium surcharges. The tax exposure embedded in a traditional 401k is a liability sitting inside what looks like an asset. At high balance levels, it becomes a meaningful one. The gap between what the rule predicts and what people experience isn't random. It's a structural output of assumptions, averages, and tax treatment that systematically make the outlook look better on paper than it performs in practice. I want to be careful about what I'm saying and what I'm not saying. I'm not saying you're doomed. I'm not saying the system is designed to fail you. I'm saying a rule built on 5 specific assumptions is being applied in a context where most of those assumptions have changed. And the gap between what the rule predicts and what people experience is a structural consequence of that mismatch. The research I've found most credible, from EBRI, from actuarial analysis, from Vanguard's How America Saves annual report, suggests that in current structural conditions, a savings rate of 20 to 25% is closer to what the original 15% rule was intended to achieve. Not because anything failed, because the pension gap, the longevity extension, the valuation environment, and the healthcare inflation trajectory together require a higher input to reach the same output. That's a significant adjustment for people who built their financial plan on the 15% premise. It's not a comfortable number to sit with. There's also a structural observation about the income floor. The vulnerability of the accumulation model, the sequence of returns risk, is most damaging when you have no guaranteed income floor. If your Social Security benefit, combined with any pension or annuity income, can cover your baseline expenses, the sequence risk on your portfolio becomes significantly less threatening. That's not advice. It's a pattern that shows up consistently across the data. The institutions that adapted most successfully to the post-pension environment found ways to recreate a floor. The retail advice never fully internalized that the floor was the thing that made the accumulation model survivable in the first place. There's also the benchmark problem. A lot of the anxiety, the feeling of being behind, is partly driven by Fidelity's widely cited guidelines. 1 times your salary saved by 30, 3 times by 40, 6 times by 50, 8 times by 60. These benchmarks are calibrated on the same 15% assumption. If the 15% assumption is structurally insufficient, the benchmarks are also understated. You can hit every Fidelity benchmark on schedule and still be behind where you actually need to be. That's the uncomfortable math at the center of this. I document this because I'm in it, not as someone who figured it out. As someone who spent years following the standard rule, noticed the gap between what the rule predicted and what I was experiencing, and started pulling data to understand why. What I found is that the confusion is legitimate. It's not a perception problem. It's not a math problem on your end. It's a rules-environment mismatch. The 15% rule isn't wrong because someone lied to you. It's wrong because it was right for conditions that no longer exist. And the standard advice machine doesn't have a mechanism for updating core rules when their structural foundations quietly shift. Understanding that doesn't solve the problem. But it removes the self-blame. You weren't failing the rule. The rule stopped fitting the environment. What you do with that understanding is beyond what I can document here. What I can document is the mechanism, the gap, the structural shift that produced it. And the fact that the feeling you've been carrying, that something is off, that the math doesn't add up, is correct. The 15% rule had a good run, 40 years. It did real work for real people under real conditions. Those conditions changed. Quietly over decades, through the pension shift, the longevity extension, the valuation environment, the healthcare trajectory, the Social Security replacement rate erosion. No single event, no announcement, just a slow structural drift away from the world the rule was built for. I'll keep tracking how this plays out. The EBRI data updates annually. Vanguard releases their How America Saves report each year. Actuarial tables shift. The sequence of returns data accumulates. If what I'm documenting is useful, subscribe. I'll keep reading the reports, pulling the data, and noting what changes.